Good morning everyone, this is Daily Trading Analysis with the weekly recap for this week, which has been a complete disaster. We started the week with a new week opening gap to the upside, and in 2 days we destroyed all that advanced because basically we got two big things this week, the PMI and the PCE. And both readings, all economic data, were higher than expected, basically implying that we have higher inflation and low growth. So that's a stagflation environment. Market participants are all navigating really difficult landscape with uncertainty, and everything reflects a prevailing negative sentiment. Among all those concerns are the looming threat of new tariffs, a mixed bag of economic data, which we can see right now with my personal sentiment analysis, the lowest this year, 25. And the persistent ambiguity surrounding the future trajectory of monetary policy. Basically, this combination has created a risk of priority and somewhat pessimistic. The outlook for the US stock market, particularly for the Nasdaq, the S&P, and the Russell, are pretty low. So the specter of escalating trade tensions is casting a long shadow over market sentiment. The potential implementation of new, additional tariffs, apart from the ones from autos, aluminum, pharmaceuticals, and even Venezuelan oil, injects significant uncertainty into the economic outlook. These protectionist measures, while aimed at bolstering domestic industries, carry the inherent risk of triggering retaliatory tariffs from trading partners, thereby escalating global trade frictions. Such a scenario would not only disrupt established supply chains, but also introduce inflationary pressures into the US economy, potentially offsetting any intended benefits. And this is a critical point of concern as we analyze the near-term prospects for market growth. Adding to the negative undertone are several signals pointing towards inflationary pressure and low growth. That means stagflation. The University Michigan one-year inflation final reading came in higher than expected at 5%, exceeding both the forecast and the previous reading. And this is basically factually negative, signaling short-term inflation expectations, complicating the Fed's inflation control efforts. This seemingly minor deviation it's actually quite telling, because it suggests short-term inflation expectations are proving stickier than anticipated. And this is from the consumer expectations. In terms of red flags from the Federal Reserves, it indicates that inflationary pressures may be more entrenched into the economy than previously hoped. And also, big data, PCE data came out this week with the super core month-over-month huge gap, huge increase to 0.37 from 0.22. We are talking about the super core. It's not the headline, it's not the core. This is the basis of the basis. The super core assets are still increasing. So, negative inflationary pressure, broader inflation beyond core measures. Also, the super core year-over-year, also rising inflationary pressures. The core PCE 2.8 higher than the forecast, higher than the previous one, again negative. And the super core month over month picking up again 0.4%. Compounding these concerns, we have year-over-year measures, datas, month-over-month, inflation expectations, super core readings. I mean, these are all negative. All negative. These higher than expected core PCE readings are really, really concerning as they strip out volatile food and energy prices. And this provides a clear picture of the underlying inflation trend. So adding to this mixed economy, we got the PMI. So what we got on the PMI? Well, contrasting views from the manufacturing and services sectors. The manufacturing PMI flash showed a contraction, lower than expected and below 50, which means contraction. Contraction in manufacturing activity below 50 threshold, it's economy slowdown. But also, the contraction signal, the conversely signal of the US S&P Services PMI flash going higher. That means higher than expected, higher than the previous one, expansion in the service sector, which indicates resilience, but also inflationary pressures. All this means that higher prices and lower manufacturing means stagflation. Higher prices and lower growth, economic slowdown. And this is the perfect storm. While the inflation data and this manufacturing, this data, it's a more nuanced picture. Basically, this is juxtaposed with the contraction on the manufacturing. Given this divergence, this is why I called for stagflation. We have also the US CV consumer confidence, which fell to 92 from 98. So the consumer confidence is also going lower. The consumer confidence is a crucial indicator of future consumer spending, which drives 2/3 of the US economy. A drop in consumer confidence suggests that households may become more cautious in their spending, potentially leading to a slowdown in economy activity. In contrast, we have also new home sales, which showed a positive surprise, slightly below estimate, but above the previous one. This increase suggests some underlying strength in the housing market, but this is not offsetting any bad data. Adding to the negative sentiment, this is crucial, a very negative indicator. Moody's, a leading credit rating agency, has edged closer to downgrading the US rating, citing concerns about the nation's deteriorating fiscal strength. This warning from Moody's underscores the growing unease about the long-term sustainability of US government debt. So this is particularly concerning because in light of potential higher tariffs and tax cuts, this could further inflate budget deficits. Such a downgrade, while not imminent, could be a significant negative signal for global investors. From the Federal Reserve, we have officials like Fed Bostic, which indicated a shift in his expectations for rate cut, now anticipated only one rate cut this year, down from his previous forecast of 2. This hawkish shift suggests a potentially less dovish stance from the Fed, influenced by the persistent, sticky inflationary pressures. Similarly, Fed Kluger stated that the current policy remains restrictive and is well positioned. So this reinforced the message that the Fed is likely to maintain a cautious approach to monetary policy, prioritizing inflation control over aggressive rate cuts. So don't sleep over the rate cuts. That's not going to happen even. So these statements from the Fed suggest that they anticipated pivot towards a more accommodative monetary policy may be slower than expected. Also, geopolitical risk, the ongoing Russia-Ukraine war coupled with rising tensions with the US and China. In conclusion, the overall outlook for the US stock market, it's really, really bearish. The confluence of potential trade wars, new tariffs, bad inflation data, bad manufacturing PMI, stagflation concerns, Moody's downgrade warning, Michigan inflation expectations, consumer confidence going lower. This is huge. This is a perfect storm. That's why I put the sentiment analysis on 25, which is the lowest this year at the end of March, at the end of the quarter. Let's move to the charts because, this is this is pretty dumb. Down here we have the S&P's volume and advanced decliners market internals. And as you can see, we started gapping up, but then we were ending the week really, really bad, below the 300 million volume to the outflow. So this is people bailing out, just going away, going off the market. So what we did, it's basically dumping everything. And the cues are not better. We can see the gap up on Monday, positive news, but then look at these outflows, below 400 millions, insane. And the advanced decliners are really dump on Friday. Friday was a disaster. So what can we see here? Let's start with the NQ. Let's start with the weekly, because we got 1, 2, 3, 4 straight weeks dumping like more than 11%, then 1 week of hope, and then another dump of 2.50% in 1 week. And the concerning part is that people were so excited here, and we got these lows here that I think we are going to revisit for sure. 19,000, 18,000. These are my two key levels. And we are heading towards that. We got this daily fair value gap, which was completely ignored. We got these lows here at 19,000, and then we got these other lows, which I honestly think we are going straight there to catch a lot of people buying this dip. And then we have the 200 moving average. We have the 200 moving average here, and we are way below that. We are 7% off that. Then we have the volume from these lows, the volume weighted, the VWAP from that. What happened? We are also rejecting that. We were crossing here. That's why a lot of people was here trying to find some bottom, but then it got smacked in 2 days. 1 day and 2 days. In 2 days, we drop all gains of March. In 2 days. The 1 hour shows you something which I think it's really interesting. Let me just go to the 15 first. The 15 minute starts with this new week opening gap. So this week opening gap was super bullish, but look at this detail. The green days, the up days we were struggling. We were super choppy. One big day, huge push. Another green day, choppy. Another red day, huge push. Look at the difference between the green days and the low and the red days. The red days are insanely efficient. So big people, big players, and based on the fact that we got the volumes and the market internals showing you huge outflows, big players are dumping everything. And I don't think it's only about US participants. This is global participants are dumping technology. Look at XLK. Let's go to the daily. XLK technology sector, it's dumping like 15%. Financials are also struggling. They are more in the way of they are stacked in a range. That range it's pretty big. It's like 10%, and this is financials. Look at banks on Friday. 2% in the red, 3, 2, 2, 3, 3, 3. This was also pretty bad. 2% on XLF. Consumer discretionary, 3% in the red. And we are from our highs 20%. And remember, this is 2/3 of the US economy. What else? Semiconductors, also huge dump, 20%. This is huge, guys. This is not only affecting a couple of stocks. What is the dollar doing? The dollar is also dumping. Weakness everywhere. With the dollar being weak, we should be stocks going up. We should be watching stocks going up. But what we are seeing is the general market. This is the RSP, the equal weighted ETF. We are seeing momentum to the downside in every single internal. We have long-term people dumping. We are at 35. Of 35% of stocks are above the 200-day moving average. This may look low. We got a low at 23, and then we got a huge jump of 43% higher. When was that? October 2023, and the big move higher. I don't think this is the bottom. Maybe we can see some kind of bounce, but I think the bottom in the Qs are around 19,000 or even 18,000. So there's more potential to the downside. And we are seeing that also in the equal weighted. This is not only about technology. This is also about the broader market. What are yields doing? The longer-term yields are pushing higher because of the expectations or less rate cuts from Kagler, from Bostic. Everything is going up, so we are not going to see interest rates going lower anytime soon. So this is basically our view. Sorry to be so pessimistic, but this is what I'm seeing. This is what I'm seeing, and you are also seeing that. When we try to go higher, it's super choppy, it's struggling, and then we are all in the red, dumping everything super efficient to the downside. This is the way price action is behaving, and we have to really understand that. I don't want to sell this market, but this is the best way of getting money right now. The best opportunity is to the downside. Look at this. Unless something big happens, some big catalyst on tariffs, and maybe, well, we have PCE already with bad data. So unless the tariffs strategy change, I don't see this changing anytime soon. And we have this low, we have these lows, and we have these lows. All are critical psychological levels. So I think we are moving towards that. That's my honest opinion. That's my honest opinion. So that's all from my side. As always, thank you for your time. If you found this video useful, please give it a like. Subscribe to the channel. I upload these weekly recaps every Saturday for you to understand what happened in the week, what I'm watching, how I'm feeling, and what's my analysis. But do your own analysis, do your homework, because also I'm sharing this, but you have to also educate yourself and try to understand what is happening. And what is happening right now, it's really, really interesting and really simple. Stagflation. You may not like it, but this is what is happening right now in the market. So, nothing else to add. I guess let's try to rest a bit during the weekend. These weeks have been super dramatic, super difficult to trade. We just have to be patient, disciplined, and apply risk management not to lose everything. We have to be smart. And right now, it's not smart buying this market unless you are a bank or a big investor. For retail like us, there's no way I would recommend buying this market anytime soon. We have to wait for big levels or big, huge change in tariffs or big catalyst. So stay safe, have a nice weekend, and see you on Monday.